OptionChampion.com.
Today is Saturday, November 5th. I'm Rick Adams, and this is Tricks of the Trade.
All data and other information contained throughout this video are for demonstration purposes only and shall not be construed as trading or investment advice or an advertisement for software or other trading applications, nor shall any part of this presentation be considered a recommendation of securities or other tradable products or related strategies. Trading and investing, whether short or long term, involve risks that may not be suitable for everyone. Any mention of past performance is not an indication nor a guarantee of future results, as volatile market conditions can arise at any time and result in substantial losses. No individual should make any trading or investment decisions without consulting a professional and conducting his or her own research.
Welcome to Tricks of the Trade on this Saturday, coming off of a very busy news week. The Federal Reserve hiked interest rates by 75 basis points for the fourth time, pushing the Fed funds rate up to 4%, the highest level since January 2008. Weekly unemployment claims came in at 217,000, below the revised reading of 218,000 in the prior week, and beating the estimate of 220,000. The prior week's reading of 218,000 was revised upward from 217,000. Non-farm payrolls increased by 261,000 in the month of October, exceeding the estimate of 197,000. The prior month's reading of 263,000 was revised upward to 315,000. The unemployment rate ticked higher from 3.5% to 3.7%. Lingering recession fears sent the cash market indices into the red on the week. The Dow lost 459 points. The S&P 500 lost 131, the NASDAQ Composite lost 628, the Russell lost 47, and the VIX finished lower by $1.20. Crude oil gained $4.22 on the week, gold gained $37.40, silver gained $1.71, and natural gas gained 77 cents on the week. In the last episode, we looked at the setup and adjustment scenarios in a collar position that I put on in Micron Technology. Today we're going to look at another collar position that I put on this week in UNG, the United States Natural Gas Fund, and other strategies I was weighing before deciding on a collar strategy. First, the setup. I'm long the stock at $19.30 per share, short the 20 call in December, and long the 16 put in December. Both options had 42 days until expiration at the time of the trade. I sold the 20 call at $2.39 and bought the 16 put for $1.09, resulting in a net credit of $1.30. That credit reduces my cost basis on the stock from $19.30 to $18 even. As you may recall from the previous episode, a collar strategy has downside protection on the long put side, and by selling a call on top of it, I receive a premium that I can use to pay for the long put. Now let's put the position aside for a moment. We'll come back to it toward the end and talk about plans for exiting and adjusting, but for right now, let's look at this as though we're analyzing a few strategies and putting together a trading plan for Monday. As of market close on Friday, the stock is priced at $20.82 per share, and we're thinking about putting on a collar strategy. Looking at the December options, we could sell a 22 call at $2.54 and buy an 18 put for $1.54, resulting in a credit of $1 if the trade is filled. So we mark that down as a possibility. Knowing that the 18 put is $1.54, we could just sell a naked put at that 18 strike and receive the $1.54 as a credit, 54 cents more than the $1 credit received on the collar spread. But UNG has been volatile lately. One day over the last 50 days, the stock traded in a $4 range, and other days as much as a $5 to $6 range. If the stock were to fall to, say, $16 and we're short a put with a strike price of $18, then we either have to wait it out and see if the stock rises back above our 18 strike, or consider rolling the option to a later expiration cycle, either at the same strike or a lower strike. So, to avoid that situation, we decide against selling a naked put at the 18 strike, and instead look at potentially hedging long stock with a long put vertical spread. Staying in the December monthly cycle, we could buy a 22 put for $3.62 and sell a 21 put for $3.04, resulting in a debit of 58 cents on the spread. On a long put vertical spread, the maximum profit is the width of the strikes minus the debit paid. In this case, being long the 22 put and short the 21 put, it would be a $1 wide spread. Minus the 58-cent debit, the maximum profit on the spread would be 42 cents, or $42 in option terms, with option contracts representing 100 shares of stock. Now, this setup, where we would be hedging long stock with a long put vertical spread, would require additional capital, the $20.82 per share for the stock, plus the $21 per share to secure the short put side of the spread. With the maximum profit being so small, it's not worth the additional capital putting on this trade. We could also sell a call to cover the debit on the vertical spread and flip it to a credit, but we already know that we can skip a short put and have on a collar spread with a credit. So we scrap this long stock, long put vertical spread as a possibility and decide to go with a collar spread. Circling back around to the actual collar position that I have on, if the stock price remains between the 20 strike of the short call and the 16 strike of the long put, then I'll either close the short call for a profit and sit on the long put for a little while longer, or buy additional shares of the stock to reduce my average cost per share and sell another call, depending on how much the stock price has fallen. If the stock price falls below the 16 strike of the long put, then I'll close both the short call and long put for a profit, average down on the stock, and either put on a new collar strategy or a different strategy altogether. And finally, if the stock price rallies beyond the 20 strike of the short call, I will allow the shares to be called away at the 20 strike for a profit and allow the long 16 put to expire worthless. That's it for this episode of Tricks of the Trade. I'm Rick Adams. Thank you very much for watching. See you next time.